In this video, I'm talking about inflation and the market and what every 401k investor needs to know. Hey everybody, it's Matthew Jackson here from 401k Maneuver. We provide online professional account management for your 401k with the goal of supercharging its account performance. So stop leaving money on the table each and every year in the form of lost returns. Let us help you. If you're new here, be sure to hit the subscribe button, and the links to everything that we mention in this video you can find in the description box below. So let's jump right in. We realize the current economic and market environment uncertainty has a lot of investors really nervous, and rightfully so. The market's pretty ugly right now. Listen or read the news, and it's all doom and gloom. And while we're experiencing tough or unpleasant market volatility, it's important not to focus too much on the negative, as hard as it might be. If we see the glass half empty and start to panic, we all run the risk of making an irrational decision that may cause regret once the market recovers over time. Though fear is a real and strong emotion, people looking past the current market action and considering the glass half full, we can avoid decisions of the heart that may cause more harm than good in the long run. Now, it's easier said than done. So let's take a quick look at historic data and talk about inflation and the market. Though there is the typical early market reaction to inflation and higher interest rates to fight it, the fact is that stocks have always been the best inflation hedge longer term. The market has averaged about a 9.4% return per year since 1928, which greatly exceeds inflation measurements by 4 to 5%. In fact, when you look at the 17 highest inflation years, the market was up 12 of those years and up double digits in 8 of the 17 years. In the 5 highest inflation years, the market was up 4 of those years. And one of the reasons is that some percentage of inflation itself is corporations being able to pass along higher costs, which stabilizes their earnings. Ultimately, this has led to some of the strongest bull markets on record. If you want to learn a little bit more, check the description box below and watch our market commentary for the end of the second quarter. Now let's switch gears and talk about why it's important to avoid emotional decisions when fear runs high. You know, most of us went through 2007 and 2008, and even recently, the pandemic sell-off, not to mention the early century tech bubble crash, among other similar times. In all cases, the market recovered given patience, and it will this time too. It might not feel like it right now, but it will. What goes down must go up, and vice versa. If you're worried about your 401k, the key is to remember stocks have always been the best inflation hedge longer term. This means your 401k may be the hedge against inflation that you're looking for right now. If you're fighting the urge to move to cash or to stop contributing altogether, before you make a move, consider the historic data that we just talked about. Also, consider that drawdown markets provide an opportunity to accumulate more for your retirement future. Instead of panicking and wanting to move to cash, can you instead view this as a chance for you to increase your portfolio holdings, like contribute more? If you saw this volatility as an opportunity, would you contribute more to your 401k? Would you? Remember, sometimes the best decision is to do nothing because the market always turns. If you have questions or concerns about your 401k performance, click the link below to book a complimentary 15-minute call with one of our advisors today.